Hey everyone, me Kevin here. A lot of folks are wondering, why does it seem like the market is suddenly selling off again? The Nasdaq going from positive and a lot of the tech sector going from positive to just all of a sudden basically cratering straight down. Now the Nasdaq's down 1% again, and it just doesn't seem like it's on any course of pausing or stopping anytime soon. Nvidia's down 4.4, Tesla's down 4.7. We don't know when it'll end. Even Facebook is down 3.4. So what's going on? Is this just a healthy pullback and something you would expect after the massive rally that we've had, or is there something bigger at play? Well, let's break down probably why the market is pulling back slightly. First, we know that Jerome Powell, after his FOMC press conference just a couple of weeks ago, indicated, hey, you know what? We're not only going to stay the course of higher for longer, but even though we've previously suggested we might have reached higher, we might need to go even higher. And guess what's on Wednesday? Well, you might not actually have it on your calendar yet. I already know you have Friday's date on your calendar, but you might not have Wednesday's date on your calendar yet. So make sure you mark Wednesday, 9:30 a.m., that's right when the market opens, to 11 a.m. Eastern Time, 6:30 a.m. to 8 a.m. Pacific Time. That is when Sarah Eisen from CNBC will actually be hosting an economic forum where we will see Christine Lagarde of the European Central Bank, Jerome Powell, obviously the Fed, Andrew Bailey will be there from the Bank of England, and we'll have the Bank of Japan governor there. Now, why is this interesting? Well, it's fascinating because the Bank of England has no control over inflation. In fact, Rishi Sunak is like, hey, we support the Bank of England and everything should be good, but yeah, we got an inflation problem in the United Kingdom. In fact, inflation just hit its highest level in terms of core inflation that we've seen in the last 40 years. Even after it was coming down, it just spiked up even higher. This is a big problem. So in other words, Jerome Powell is going to be sitting on a panel with a bunch of hawks who are like, yeah, we got to do a lot more to tame inflation. And I have a feeling that of the many reasons we're going to go through in terms of why markets are selling off now, one of them is Powell. Powell speaking Wednesday. Here's that chart, by the way, of Bank of England inflation hitting a 31-year high. You can see that sort of right above my head here, that how it started going down. This is core inflation. And then you get this new spike up. Yikes, not great. So that's one reason. You've got Powell. Then on Friday, you have two things going on, and there's even more going on. But Friday, you've got the personal consumption expenditure gauge coming out. That is the Fed's preferred inflation metric. We are looking for a month-over-month read of just 0.1% inflation, a year-over-year read of 3.8%. That will be down from 0.4 on the month-over-month and 4.4 on the year-over-year. However, core is expected to move just from 0.4 to 0.3 and stay flat for the year over year at 4.7. And that sticky core is believed to take potentially higher interest rates to really push those core prices down, since higher interest rates generally affect businesses more than they affect individuals. But businesses are the ones that provide jobs and hire people, and so if you squeeze money out of businesses, maybe, just maybe, you could slow down spending in the economy to finally deal with inflation. So PCE will be coming out Friday morning at 8:30 Eastern, 5:30 a.m. Pacific time. I will be covering that live. At 7 a.m., we'll get the University of Michigan sentiment surveys again. And between now and then, we will also be getting a GDP report. Now, I want to give you the time frame for GDP report and expectations, but remember, Friday night, we've got an expiration for all the programs on Building Your Wealth linked down below. You get lifetime access to the course member live streams. Most popular bundle right now is the Trio bundle. It's the Stocks and Psychology of Money, very popular standalones, the most popular standalone course. Next most popular bundle is Stocks and Psychology of Money and Real Estate Investing. But the most popular bundle in total right now is the Trio, which is How to Make More Money, How to Make More Money and Get SH90 Done Faster, featuring AI, like actually productive uses for AI, with stocks and with real estate. That trio is really popular. If you have questions, you can always email us at staff@meetkevin.com. We'll get back to you right away. And check out the link down below for that program. Make sure to sign up before Friday, as the prices will be going up Friday as we release new lectures this weekend. So what's coming up else this week? Well, we've got GDP and another big catalyst we're going to talk about. But first, on GDP, we will have an annualized GDP read coming out. We are expecting a 1.4 read, and the prior read was 1.3. So we're expecting that GDP to show a little bit more strengthening. You have a little bit of a double-edged sword here. You want the GDP rate to be higher because you don't want to be in recession. But you also don't want the Fed to continue to feel like they have this runaway economy and they need to keep hiking, because then there's the risk that the Fed will overdo it. The current estimate of the Fed now real GDP levels are that GDP for the United States should be coming in at 1.9%. That is revised lower from where we have been previously, knocking on the door of 3% in May. So we've definitely seen some softness here, but well above that zero level. In fact, there's a lot of talk that residential real estate investments, especially new construction home building, could actually pull us out of a potential recession. If we were to trend into one, housing spending on new construction could actually keep us out of one. Pretty remarkable. So we'll keep an eye on those GDP numbers. But in my opinion, what's really the big catalyst that everybody's kind of holding their breath for and that's making everyone nervous? Well, honestly, earnings. Because think about it. Everybody on one hand is like, all right, good, the Fed's going to stop hiking because, they're finally slowing things down. And then the Fed's like, JK, we're actually not going to stop hiking. And then everybody's like, well, fine, we'll keep the rally going as long as earnings are good. Oh, earnings season really starts on the 18th, which is the third week in July. So it seems a little premature to really start pricing in earnings for Q2, but I kind of think you're getting this idea from a lot of managers or even some retail who are like, look, we did great for the first half of the year. Let's take some money off the table and just take some tendies and be happy that we had a really good first half of the year. It's entirely possible. I personally think selling right now is kind of like saying, we're done. We don't care how long this bull run goes. We're done. Okay. I mean, I think you need a larger catalyst than just profit taking. I mean, I don't really want to pay taxes, but, rather ride the waves a little bit. We wrote them down in 2022. It's like, this should be a nothing burger for you. But anyway, you've got CPI coming out on July 12th, and you've got the next FOMC meeting after earnings start. So it'll be right in the thick of the beginning of when you have this earnings season. But the FOMC meeting is the 25th to the 26th, so the press conference will be on the 26th of July. But Q2 earnings will start, of course, with the banks. Delta will actually come slightly before that on the 13th, but the banks will start the week of the 18th. So you get your Morgan Stanley, your Bank of America, with Tesla reporting earnings or scheduled to report earnings on July 23rd. We're less than a month away of that. So if people wanted to correctly position before earnings, now would be a natural time to do that, especially as you go into month end. So it is possible you could have a little bit of a rough week going into the end of the month here, especially as we wait to get over JPOW here. And as we get into earnings, that's when we'll be in the Fed blackout period, but you'll be dealing with earnings. So that'll be the next catalyst to either keep us flat or down leading into it, or potentially down after earnings. So it could be a reason to get out of certain stocks before earnings, and then you don't have to worry about earnings anymore. Although I feel like we just went through earnings, but we say that every time. So that's probably why you're seeing some heart palpitations. There wasn't anything particularly crazy that happened in markets today that all of a sudden sent stocks lower. Other than expectations that maybe the 10-year is going to rise a little bit going into July. But beyond that expectation, there really was no news that came out to indicate that stocks should be selling off. This, I expect, is likely and highly because of the catalyst that we've mentioned here. JPOW this week, then this idea that JPOW is willing to tighten, meaning we are more reliant on earnings, and earnings are around the corner. Which means now we got to be like, ooh, are earnings actually going to justify that rebound that we had off of the floor of the end of 2022? So, as always, check out the programs on Building Your Wealth. If you're a long-term investor, these fluctuations should be buying opportunities, a chance for you to increase your quantity of your favorite shares. If you're really nervous about seeing your year-to-date return go down, then you're trading, and that's okay. And that might be an opportunity for you to say, yeah, let's lock in profits. Anyway, thanks so much for watching, and we'll see you in the next one. Bye. Now, I want you to know this. When it comes to AI,
time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by